Okay, let me start with a question. What if I told you one of Africa's most exciting tech revolutions is about to get crushed by a tax policy? Nigeria's crypto market, now a $92 billion powerhouse built mostly by Gen Z innovators, is staring down a policy that could send it all offshore. And honestly, the debate here isn't just about money. It's about who gets to shape the future. Let's unpack this. Nigeria's crypto scene didn't start because the government wanted it to. It grew because young Nigerians needed a way to get paid globally, send money home, and protect savings from a naira's crashes. Crypto wasn't a hobby, it was infrastructure. Now, the government's new tax rules are treating these users like ATMs. The kicker: they're not even taxing profits. They're taxing movement. Let that sink in. One thing that immediately stands out is how this 1.5% stamp duty works. Every time you swap naira for crypto, even if you're just moving funds, you pay a toll. Lost money on a trade? Still pay. Sending cash to a cousin in school? Toll booth. This isn't taxation, it's a usage fee for participating in the modern economy. And the 1% withholding tax on sales? That's like taxing the total value of your grocery cart instead of the profit you made from buying apples on sale. It's nonsensical. But here's the deeper issue. Nigeria's government is ignoring a global pattern. India slapped a 1% crypto tax and watched 81% of trading vanish from regulated exchanges in 4 months. Kenya's 3% tax got axed in 2025 after driving users to black markets. Turkey ditched similar rules last year. So why does Nigeria think it'll work? What this really suggests is a disconnect between policymakers and the reality of digital economies. When you tax transactions instead of gains, you punish exactly the people building financial resilience. And let's talk about the youth angle. The Digital Assets Coalition calls this framework anti-youth in effect. And honestly, they're not wrong. Most Nigerian crypto users are under 30. They transact small, they transact often. These taxes compound against them like a reverse compound interest. Imagine being a student who earns $200 freelancing, converts it to stablecoins to avoid inflation, and suddenly owes taxes on the entire conversion. That's not fair. It's financial sabotage. What many people don't realize is how this clashes with Nigeria's own tax laws. The law says taxes should be paid in naira, but this framework wants payments in crypto? That's contradictory at best. And while the government might think taxing everything will boost revenue, history shows it just chases innovation underground. The real question is, why tax participation in the global economy? If Nigeria wants to lead Africa's tech future, it shouldn't be building roadblocks. It should be handing out maps. So here's my closing thought. Every time a government misunderstands crypto, it's not just a policy fail, it's a generational warning. The youth aren't resisting taxes because they hate paying dues. They're resisting because they see a future where their hustle actually matters. And if Nigeria wants to keep its place as Africa's crypto titan, maybe, just maybe, it should stop taxing the engine that's already driving the economy forward. What's your take? Is Nigeria's government shooting itself in the foot? Or is this just growing pains for a new market? Let me know in the comments, and if you're new here, hit subscribe. We dive into stories where tech and policy collide, every week.